Now that we've defined money, we've talked about the financial system, loanable funds markets, the fractional reserve banking system, and interest rates, we're ready to talk finally about monetary policy. So I want to give you guys a little bit of a history here of the global monetary system or the global financial system. Very, very brief history, so you understand the evolution of how this has worked over time. And it is still evolving today. So later on, when we talk about the tools of the Fed, we'll look at tools how those tools have changed since the last recession. All right, so before World War II, basically every major economy had a gold standard. Before that, even some currencies were pegged to the value of gold and others were pegged to the value of silver, but many currencies were backed by some commodity, okay, that had a fluctuating value according to the market for that commodity. And the price of gold goes up and down and up and down. But the currency was backed by the commodity, so the government would say, if you brought a dollar bill and gave it to the government, they would exchange that for some set amount of gold. Now, this maintains a fairly stable value for the currency. Like, you always know exactly how much gold your cash is worth. But it is quite expensive to maintain that fixed peg because there is no reason why $1 should always be equal to some set amount of gold, right? Or 1 ounce of gold should always cost $35. The price of gold fluctuates according to supply and demand for gold. So in order to maintain those currency pegs, the countries would have to buy and sell gold and dollars on the US, on the market in order to maintain that value. And this is quite expensive to maintain because the government is going to have to be buying and selling gold on the open market in order to constantly maintain this set price. Now, in World War II, you know that the economies in Europe were largely destroyed, right? As well as the infrastructure, right? The war really took a huge toll on the economies of Europe. So as the war is coming to an end, the Western powers get together at this conference called the Bretton Woods Conference, and they try to figure out how they're going to rebuild after the war. Part of what is established during this conference is a system to manage our global economy. So we have the International Monetary Fund, which oversees the global financial system, helps countries regulate their currencies, and offers loans to countries in times of financial crisis. And the World Bank, which is also a global institution aimed at giving loans to promote development in low-income countries. But in terms of currency, what the major change that happened here was the adoption of what we now call the Bretton Woods system, where the US maintained its gold standard, maintained the peg, the fixed price of gold at, say, $35 an ounce, and the other major economies pegged their currencies, fixed the value of their currencies to the price of gold, to the US dollar. And this is really a point at which the US dollar becomes sort of the de facto world currency, where the US gains much of its monetary dominance in the system that we have today. So every country in the world is relying on the strength of the US dollar in order to maintain stability in their own currency. And so this system also has now gone away because, again, these currency pegs are really very expensive for the government to maintain and don't allow a lot of flexibility in responding to economic crisis. So in the 1970s, we had these really big oil price shocks where the price of oil went way up because the OPEC countries instituted an oil embargo on the US. And the US was then in a deep recession with very high inflation, which we'll talk about. We'll return to this a little bit more in the next topic. But what we had was this really high inflation rate, right? Our currency, the value of our currency was going down, right? As we had a high inflation rate, and we also had a recession. And so at that time, the US adopted the type of monetary policy that we use today, and that really all major economies use today, which is to allow the value of our currency to float freely, not attached to the value of any commodity. So now what determines the value of a dollar is the market for dollars, not the market for gold. So we have now supply and demand of money, which of course is managed by our central bank in a way that we hope promotes a smooth functioning of our economy and a stable value of our currency. I should mention that some smaller economies still do peg the value of their currency to other countries' currencies. So for example, Belize pegs its currency 2-to-1 to the US dollar, meaning that every US dollar will buy 2 Belize dollars, and that will always be true. And in some sense, for smaller economies, they're avoiding the burden of having to manage their own currency, having to manage their own monetary policy, but they are just importing whatever monetary policy the country that they've pegged their currency to adopts. So whatever is happening in the US may be different than what's happening in Belize, and the way that we manipulate the value of our currency may be not suitable to what's going on in Belize. So there are kind of like pros and cons of each of these methods, but I think that what we widely agree upon now is that the ability to control the money supply, to control our monetary policy, to respond to really immediate crisis is a powerful tool for the government to use to help to stabilize the economy. All right, so we're going to talk now a little bit more about how this works. And here what we have is a graph of money supply and money demand. So money supply, you'll notice, is a vertical line there. Yeah, money supply is fixed in the short term. It's fixed. Right? That's the amount of money that is in the economy. It does not depend on the value of money. Instead, it is determined by the Federal Reserve or the central bank. Oops. In the US, we call the central bank the Fed. And this setting of money supply, the influence over money supply, is what we mean when we say monetary policy. All right, money demand. Money demand is downward sloping. What is money demand? It's the amount of your assets that you would wish to hold in liquid form, right? Remember, what is money? Money is anything that we use to trade with each other, right? Currency, hard cash, checking account, savings account. What's not money? Your house, stocks, right? Bonds, right? So how much of your wealth are you going to hold in your checking account, in your savings account, versus putting them in other types of investment accounts? That's sort of the best way, I think, to think about money demand. So why do you hold money in your checking account rather than putting it into a savings account or an investment account? Because you want to spend it, right? So the only reason to hold assets in more liquid form is so that you can use them as a medium of exchange. Because if you're not planning to spend that money, you would want to put it into an investment account that's going to yield you some rate of return, some interest on your investment, since you're loaning it out to other people who are hopefully doing productive things with it, and then you will get some rate of return. So the only reason that you want to hold money in liquid form, hold assets, right? The only reason you want to hold your assets in liquid form, in money, is because you think you might want to spend them. So this, of course, is related to the value of money, okay, which is synonymous with the price level. So when I say the value of money is high, what does that mean? It means that every dollar buys a lot of stuff. And if every dollar buys a lot of stuff, that means the price level is low. And vice versa. If I say that a dollar isn't worth very much, the value of a dollar is low, it means the price level is high. $1 does not buy very much stuff. So you'll notice here that on the y-axis, I have the value of money, okay, which is determined by money supply and money demand, but I also have the price level, and these have an inverse relationship. When the value of money is high, the price level is low, and vice versa. So demand for money is downward sloping because the lower the value of money, the more money I need to buy the stuff I want to buy. Right? The only reason I hold money is to buy stuff. If prices are really high, I need to hold a lot of money to buy all the stuff I want to buy. So that's why demand for money is downward sloping. Let's see. Let me write something down here so you have something concrete to write, that the share of your assets that you wish to hold in liquid form and by that I mean money, okay, is inversely related to price. Good. So that's why money demand is downward sloping. Now, money supply shifts when the Fed decides, right? The Fed decides to expand money supply, they'll expand it. Contract money supply, they'll contract it. And we're going to talk about the tools they have to do that because it's actually a little bit complicated in a future video. But what shifts money demand, it has to do with the preference over how much money consumers want to be holding. And so I want to list just a couple of things here, right? So changes in consumer tastes and preferences. Suppose I'm nervous about losing my job, or I'm nervous about the state of the economy. I might just start spending less money, right? Or say I'm feeling good, I might start spending more money, right? This is going to impact demand for money and therefore the value of money and the general price level. Okay, changes in real income. If I have a higher real income, I'm going to probably increase my consumption spending, and therefore I will increase the amount of money that I would like to hold. And then the last one here is going to be changes in foreign demand. So a lot of our currency is held by people in other countries, but also every time that someone wants to buy something that was produced in the US, they need US dollars to do that, right? So we have foreign exchange markets that allow the conversion of one currency to another currency, and that's going to also affect demand for US dollars. All right. So let's just do a quick example here. How would a decrease in money supply affect the value of a dollar and, right, the general price level? All right, well, we have a decrease in money supply. Okay, that's going to increase the value of a dollar, right? There's less dollars out there circulating, so the value of each dollar will increase, meaning each dollar buys a lot more stuff, so the price level would be decreasing. Right? and that is something we would call deflation, right? Inflation would be an increase in the general price level. Deflation is a decrease in the general price level. Right. Kind of at the bottom of the page there. Okay, now hopefully you understand how the value of our currency is determined. It relies a lot on consumers, and it relies, okay, hopefully now you understand how the value of our currency is determined and the importance of monetary policy. What I want you to do next is I want you to watch 2 videos from Marginal Revolution University, one about tools that the Fed uses to impact money supply, the classic tools before the last recession, and then I also want you to watch the video about the new tools, right? And then we'll come back to talk about interest rate targeting and exchange rates. All right, I'll see you in a couple videos.